Hello, everyone, and welcome to our webinar. Today, we are going to start talking about accounting and systems considerations for mergers and acquisition activity. Today, I have with me Julio Della Costa, Director of Technical Accounting and Head of our Account Advisory Practice, Kim Dowling, Director of Treasury, Head of our Treasury Practice, and our newest person to join is Melkonian. He is the Director of PMP, Enterprise Architect, and does a lot of stuff around S/4HANA. Everybody, welcome. As you know, we record these webinars, so I encourage you to go ahead and check out of our webinars. You can ask questions throughout the session down here in the little box, as we've pointed out. So feel free to ask questions. We'll take any of your questions. Those we can answer real time, we will do. And some of them we may not get to, so I promise you that we will follow up with you. And thanks for all of you who shared some of your insights on issues you wanted to see. We'll be using those throughout the presentation. And of course, you can download previous webinars from bramasol.com. I encourage you to check that out. Go up here to the Resource Center, and you can link in and see all of the different webinars and content that we have available. In addition, you can just scroll down the page and pick any of a number of specific pieces of content that you're interested in, as well as, by the way, checking out some of our really great customer stories. You can contact us at bramasol.com, go to Facebook or LinkedIn, and as I announced previously, yes, we do have a YouTube channel. We would love to have you join our YouTube channel. And you can subscribe to that, get the latest updates. We post all of our latest videos and webcasts, so you'll have advance notice and insights into all of that. So without further ado, I am going to turn this over to my colleague, Julio Della Costa. Today, we're going to focus on mergers and acquisitions, which seems, Julio, like kind of an odd thing to be talking about during this time of economic disruption. But I think that as we begin to emerge, you'll talk about some of the trends and opportunities, and we'll have an interesting dialogue about why this is something folks may want to pay attention to. So Julio, off to you.
Thank you, John, and good day, everybody. So yes, John, this is an interesting time to talking about M&A. However, what we'll see during this presentation is we're going to talk about M&A from three different angles. We're going to talk about some of the accounting considerations, but we specifically, with what's going on in the world today, we really want to focus in on Treasury within an M&A process. And then lastly, we want to talk about one of the what we believe is a great platform for mergers and acquisitions within the SAP family of software, which is central finance. And that's why Bob is here. He's going to talk to us about that. So on the agenda today, we're going to talk about some of the trends. Then we're going to talk about some of the common mistakes that people usually make. Then we're going to talk a little bit about what happens after the diligence. What happens after you do your post-diligence? We're going to talk a little bit about the harmonization of accounting policies. And then we're going to talk about a very important topic, which a lot of people don't think about during an M&A process, which is how do you manage your working capital adjustments after the acquisition? So John, without further ado, why don't you go to the next slide? So before we go into the M&A trends, we just want to talk about large parts of the world are currently shut down, right? So a lot of global mergers and acquisitions are currently on hold, but I say that with a tongue-in-cheek almost, because they're on hold. But if you see what's going on in today, a lot of companies are still pursuing opportunistic rescue deals, because what has happened with the public markets, a lot of the stock price of these companies have decreased. And that leads to a lot of opportunities. I don't know if you saw in the news recently, John, but there's the Saudi Arabian investment fund. They've been very active in the markets in the United States, picking up some large public company investments. So even though today it may seem sort of the market is down as far as M&A, we expect in the Q3 and Q4 that the activity to significantly pick up. John, your thoughts on this?
No, I agree with you, Julio. In fact, I did see that deal given my personal interest, having spent a great deal of time in the kingdom many years ago. So I found that interesting. I also found interesting recent articles by Bain Consulting and McKinsey that talked about um, how M&A they expect to start taking off, particularly as you see these um, companies begin to emerge and others needing to be picked up. So yes, absolutely, I agree with you.
Yep. Next slide. So before we go into some of the common trends, let's talk about just the M&A process and why companies do it. Many organizations continue to increase their earnings through better managing their cost and balance sheets. However, global competition intensifies. Investors and boards are demanding more top-line growth as a way to further increase shareholder value. Many are pursuing this growth in revenues and earnings through mergers and acquisitions, which are some of the challenging endeavors any company can or will undertake. If you think about a merger and acquisition process, there's basically 4 stages of an M&A process, which is you have the strategy and sourcing, which comes from your board of directors. Once you identify a target, you go through your due diligence process, and then you have your integration planning process, and then you have your execution of that integration plan. However, what we find is a lot of companies make a lot of errors and mistakes when it comes to that process. Some of them I wanted to talk about just to give you a good feel of some of the mistakes that people make. The first one, as we talk about, is improper planning. Failure to screen targets using appropriate criteria aligned with value creation strategies and targeted synergies. What does that mean? That means that every industry has a multiple. Usually it's an EBITDA multiple, an earnings multiple, and that is usually the most common way that companies are valued. So if you take like a tech industry, they will have a very high multiple, maybe 10 times earnings, 20 times earnings, versus a consumer products company, which will have a lower earnings multiple. Very important, and usually companies hire these significant large consulting firms to help them with that planning process. Second part of this is failing to move the discovery process along quickly. What does that mean? It means that once a target has been identified, I'm pretty sure that that company will not be the only person looking at that company. So time is always of the essence in these deals. The third one I really wanted to focus on is poor due diligence. How many times have we seen in the news or been in company environments where the due diligence is done in a matter of hours or days because companies want to get in the industry? The company is, as we call them in tech unicorns, and they pay a substantial multiple for that value only to find out after the fact that that value has not been realized. So we always stress when it comes to M&A deals, proper due diligence, financial numbers matter. If you think about another common mistake is really paying substantially more than fair value. So we talked about that in the beginning of where we say companies and industries are valued on multiples. If you don't know what the multiple is, a realistic multiple of fair value, then you will always happen to be paying substantially more. Why does that matter? That matters because once you buy a company, you usually have to put in your balance sheet goodwill. And then guess what? Every year, goodwill is assessed to see, is the value over the book value of the company still at that value? If not, guess what? You're going to have an impairment. Quickly, on the last one, we talk about the post-acquisition issue, which Bob will talk a little bit about, and Kim, as we go forward, is, when you talk about mergers and acquisitions, when you have these press releases of these large companies, they always tell you because of synergies, they're going to save $1 billion in expenses. They're going to save 500 million on integration. And what that means is, when you have two companies come together, in the back office especially, You have two accounting departments. Well, you don't need the two accounting departments, so you try to integrate them into one accounting department. You probably don't need two sales departments. You don't need two marketing departments. So usually companies make these calculations based on, if I reduce headcount, I integrate the synergistic opportunities here, we're going to save. But what we find is, after the fact, a lot of these do not materialize. And I want to bring in Bob, because Bob is a project management expert here. Bob, from your perspective, what do you see in these post-acquisition issues?
Some of the issues are underestimating the processes and the data that has to be mapped and harmonized. So I had a client, as you know, that was a Fortune 100 client, Julio. And so there's a lot of pre-work that needs to be done just in developing, common reporting models, common structures of that type. So I think that's what I saw underestimated. It's not actually just the merge, the technical side, but a lot of the pre-design work that needs to be done.
Yeah. And Kim, what about you? You've worked in large organizations with mergers.
Yeah, what you're saying is so very important, because a lot of folks don't, sometimes they take it a little bit for granted and don't really concentrate in this area. It's incredibly important that you step back and do your pre-work to make sure, what are you going to be eliminating? What are the synergies that you're going to be having? How are you going to merge these processes together? And then how are you going to handle the technology part of it as well? There's a lot of work that goes into it, and you really have to think about what's your current state and what is your to-be state and how are you going to get there. It takes a lot of work and thought to get there and to do it right.
And the one thing I wanted to, before I leave this page, is culture. Always remember, culture drives a lot of that merger success. Personally, I've been in a merger where the two companies were basically on the opposite sides of culture, and it led to a lot of challenges and hostilities after the integration actually happened. So even though the numbers drive these mergers, don't forget about culture. John, next slide, please. So let's talk about what happens on your working capital adjustment. So what is a working capital adjustment? So you go into a company, you offer a fair price, and then you buy the company. The working capital adjustment is usually something that is managed by the accounting department after the fact. So working capital, basic definition, it's current assets less current liabilities. Your current assets, you have things like accounts receivable, you have inventory. On the liability side, you have current liabilities, you have accounts payable. Really, what you're trying to do is, if I have $1,000 in accounts receivable and I have $500 in accounts payable, the working capital adjustment is somebody is tracking every month the realization. So of that $1,000 in accounts receivable, how much was actually collected after the fact? Of the $500 in accounts payable, how much was actually paid out? Did we have to pay out double that amount? And usually what happens from a working capital adjustment scenario is, at the end of 12 months, some companies do it 6 months, is you come into and say, you know what, my AR, that $1,000 of AR that I paid for, we only collected 50%. And the $500 that I booked on acquisition date of accounts payable, I actually paid out $1,000, double. So therefore, at the end of that period, we do an acquisition adjustment to the balance sheet, and we say, okay, the working capital was $10 at the end of acquisition day one. On day 120, that working capital adjustment either goes up or goes down, depending on how the accounts receivable, accounts payable, inventory, cash in the bank, investments actually realize. Kim, on the Treasury side, what do you see as your working capital adjustments you wanted to give us?
Well, one of the important things for me is being able to have the visibility of what working capital is, so we can actually work with our accounting standards areas to be able to come up with what an adjustment is. And what I find in my focus areas of my cash and liquidity management, along with my payment and bank communications modules, and SIP as an example, is where I'm able to actually focus within that treasury and finance and be able to see that visibility of working capital. What is it? Because it's really important that we can actually maintain those efficient cash flows to meet those short-term and operating costs and obligations, either, just pre-adjustment, so we know what that value is, and then post-adjustment, so then we can maintain that go forward, and we know what we have at any period in time.
Yep, thank you. John, next slide, please. So now we come down to the nitty-gritty of any integration process. When you have, so you've bought the company, you're tracking your working capital. Now we start thinking about or start executing on the integration of these two companies. First and foremost, every company has customers, every company has vendors. Some critical day one questions is, and this is where Kim will come in the next slide, is who's going to pay those vendors? What bank accounts are we going to use? How are we going to integrate our customers? Who's going to receive the money? Is the money going to be received by the legacy bank accounts, or are we going to use a combined new bank account? Very important day one decisions. When we look at the organization, and this is where synergies come into play, all mergers have these combined finance organizations. So normally, you can't have two CFOs. You're not going to have two controllers. Are you going to have two accounts receivable departments? So usually this is done in diligence phase, where you have a planning stage, where you start thinking about, who's going to lead the new organization, and all these back office functions, who are going to actually integrate them? Are we going to stay with a combined? In my experience, I've been in acquisitions where the directive is we're going to have 50-50 of the staff. So 50% of the one company, 50% of the old company. And then what you find, though, in reality is, even though there's a merger, somebody is the lead on that acquisition. And then you find people leaving the company, and then you have other people coming in. Another thing, from an accounting perspective, very important, is your harmonization of your accounting policies. If we look at revenue recognition, especially in the days of the new accounting standard, ASC 606, you think about what are the policies that we're going to harmonize, especially if you have goods, you have different services, you have hardware, you have software, you have product, you have services. Revenue recognition is being, it's something that has to be significantly harmonized once you go into a merged organization. Why do I say that? Because once you have a combined entity, you have to have one revenue recognition policy. So for instance, a good example is, if you look at variable consideration, there's two ways to do variable consideration, right? You can have your expected value or most likely. Well, under US GAAP, you can't have both. So if one company was doing expected value, another company was doing most likely approach, somebody has to say, going forward, we in the organization, we're going to use one approach. Accounts receivable, accounts payable. If you think about it, some companies offer, what is your estimate of bad debt? A lot of companies do 90 days. Some companies do 60 days. Some companies do 120 days. When you go into that new organization, you have to harmonize those policies and say, okay, bad debt will be 120 days for the new entity. Accounts payable as well. A lot of companies offer 210, so you pay within 10 days, you get 2% discount. Some companies offer 215. So it depends on, these companies will say, okay, what is my old legacy policies and what is the right policy going forward? Fixed assets is the same thing, very common area. What type of depreciation am I going to use? Some companies depreciate vehicles over 5 years, others use 3 years. Computer and software. Some companies use 3 years, some companies use 7 years. It just depends, and usually in my experience, there's been a lot of companies where they come in and they have to say, okay, let's harmonize these policies. I want to bring Kim in because Kim is very close to these policies, especially AR and AP. Kim, what do you think about these integration processes?
Well, Treasury, as you could imagine, I've spent a lot of time there, is that Treasury is very integrated with all these operational areas, such as what you've mentioned here at the accounts receivable, accounts payable. One item I also wanted to point out is supply chain. Think about the timing of that and how that might impact your receivables and payables and your cash flows. And it really is important that, for these cash flow type items, that we need to really coordinate with these areas early on, not waiting till later. it really will help it helps Treasury to actually understand the necessities of the company, and it really actually also enables us to develop a strategic vision of how we're going to support the needs of the company from the beginning and drive to that operational realities in the short term, and of course the desired end time and end state as well. So it's very important that full coordinative efforts right early on.
Yeah. So with that, John, I'll turn it back over to you.
Thank you, Julio. Great job. And I guess, with the next slide, Kim, let's talk more specifically about the Treasury activities. We do know that Treasury is clearly one of the most affected units out there. I recently read, believe it or not, there is actually an Institute for Mergers and Acquisitions, and was reading one of their articles, and they said one of the key places that people underestimate both the amount of work as well as the opportunity for synergies is in Treasury. Maybe you can talk a little bit about your experience and your perspective.
Yeah, there's a lot to be said in this area as relates to Treasury, and I think a lot of folks, because they don't sit in that Treasury chair, they may not always be with them at the table. They don't always realize the complexity of this area. But one of the critical drivers for our mergers and acquisitions, it could be divestitures as well, is for the success is that we have that ability to drive that cash generation and manage those financial risks and maintain that capital market access. So as we see with the mergers and acquisitions, companies do tend to focus on the deal synergies, and they don't always adequately consider how they're going to identify, assess, or mitigate the operational or organizational risks which do lead to failure. So what we're end up finding is that, without this lack of understanding of required deal structure, it results in unrealistic goals, and we have misaligned expectations, as it also not just within the deal structure itself, but also later on, even with, the Treasury transformation process in itself. So with what we're also finding is that in many of these transactions, that's so critical to drive that cash generation and manage those financial risks. It's very critical drivers to the success. And we also find that it's really important that Treasury has a place at that table early on in the deal planning, so that we can actually be there to highlight any kind of actions that need to be taken or any kind of complex issues that may come up from the deal from the start all the way to the end. Because the Treasurer, they really need to understand the needs of the company. They need to develop that division. How is Treasury going to support those needs post-transaction? Is Treasury going to conduct a structured, process-based assessment of all aspects of the deal? They're going to be involved in the Treasury functional, the IT requirements, the external debt refinancing, covenants, the constraints, organizational structure, IT structure, and strategy, operational efficiency. There's so much involved. I mean, just think about all the alternative business models that are going to need to be defined for a desired to be or the end state solution. The value that they bring to the table as a whole is really important in ensuring that we have the deal structure is successful, and we also have the improved operational efficiency that we're going to need when we bring the two companies together to ensure that we're reducing those risks and we're minimizing any kind of costs. So one of the things that I like to talk about is when you're starting to go into either a merger and acquisition or divestiture, is that the role of Treasury, as you know, it is becoming much more critical than ever. And it's not just, from evolving from a tactical role, but it's really a very important strategic partner and advisor to the business. So when you're looking at including Treasury's evolving role, it's really providing that strategic support for those mergers and acquisitions. And it's not just, the pre-deal, but very important in the post-deal integration. And this support can be really extensive and complex. For example, an acquiring company will likely be taking on the debt to refinance the deal. They're going to be raising equity. They're going to be changing its working capital structures. They're going to be adding liquidity risk. And the Treasury team really needs to be involved in managing that whole process in the go-forward state. So on these pillars here, if you look at this with the strategic support, we're looking that, Treasury needs to have that connectivity and alignment with the internal and external stakeholders. And there's that growing expectation from their leadership that Treasury is going to be engaging in all those strategic decisions, whether it be mergers and acquisitions, any kind of growth plans or changing any kind of business models go forward. They're also going to need to focus on risk. What's going on with, our post-financial crisis changes that we might be in, like what we have right now that could be going to be coming, right before the next merger and acquisition. What about the increased volatility that they're going to be running into with the foreign exchange risks, the commodity prices, and look what's going on with the interest rates. Or regulatory changes, which are very important as well and never to be overlooked. And that's why Julio and I tend to partner quite closely in this space. Julio, you might want to, could you talk a little bit more about the regulatory changes?
Yeah, well, as you go into a merger and acquisition process or even a divestiture, it's very important because if you think about it, especially from a multinational perspective, you're not just dealing with two different types of regulatory changes, between the two companies in one territory, but then you also have to think about the cross-border changes as well. So you think about, if you have a European company merging with an American company, you have IFRS considerations, you have US GAAP considerations, and then you have, again, that harmonization of those two. I actually was involved in a merger between an American and a French company, and one of the things that we encountered was for revenue recognition, they were still doing milestone billing, and we were doing percentage of completion. There was about a 6-month project to harmonize those changes between the two companies, and it was across different units all over the world. So very important, Kim.
I totally agree with that, and something not to be overlooked. And then you've got your centralization where you're looking at visibility into all of that global cash, and we're looking for it to be in one single source of the truth. Because if you don't have that accurate and timely visibility, it's going to be very difficult to make those on-the-fly decisions and be able to help with the pre-merger and post-merger. We're also looking at, look at technology transformation, incredibly important area where Treasury departments are not just looking at getting the information from many sources. They're going to have to look at, what's the acquiring company? What's their current company look like? How are we going to blend those together? How are we going to organize our data? What kind of data do we need to bring in? How do we need technology-wise? What do we need to change? How are we going to operate as we're going through the merger and into the future state? And Bob and I have a lot of conversations around this space as well, because it's really important to be able to understand and be clear on where you're going through the technology transformation. Bob, do you want to add anything to our technology transformation topic?
I'll discuss it during central finance. Thanks, Kim.
Sure, no problem. So we can go off to our next. So now this is really important as well. There's a couple of key topics that I wanted to mention as it relates to the mergers and acquisitions that are very key into success for in the Treasury's role. As Treasury, as I was talking about earlier, very important strategic advisor and critical through the whole success of any one of these topics, right from the beginning all the way straight to the end. And before I even got into talking about merger and acquisition itself, one of the things that I've experienced when I was actually working for a client, we were actually doing a divestiture. I was on the acquiring side of it and working also with the other company that was doing the divestiture. So I was working on both sides of the fence there and providing guidance. But when you're in a case of divestiture, the new company is often going to have that need to have the ability to develop and integrate its Treasury functions from day one. I mean, they gotta know what they're doing, and they have to find a way to actually be able to pay their people and be able to make sure they have the ability to move cash. So ends up what's happening is during that interim time, they're going to be actually looking at the parent company to help provide the a TSA. It's going to be essential that Treasury engage in those pre-deal diligence so they can actually define the scope of the services that are going to be provided by the new company. But they also have to work with the current company, the parent company, to help them during that interim state to actually provide any kind of support they're going to need for moving money or actually for any kind of visibility and so forth until they can get their processes and systems fully up and running, at least in that short-term period while they're working on trying to open the new bank accounts and get everything, getting the payroll processes all in place and tested and so forth. But with developing, if you're looking at your prepared Treasury systems and day one ratings and beyond, you are looking at your data warehousing and looking at how you're going to do that ERP integration. But it's going to be very important that we're also looking at developing that strategic vision, developing that vision of how do you want Treasury to support those needs post-transaction. You're going to be looking at conducting like a very structured process-based assessment of all your aspects of the deal, which also includes the Treasury functional, the IT requirements, the debt financing, and so forth, so that you can actually have that improved operational efficiency and reduce those risks, minimize your costs. Once that strategic vision is formalized, it should be able to drive all the subsequent deal decisions thereafter. And within the regulatory changes, you're going to be, looking at all your ECC reporting. You can be looking at your FBAR for your foreign bank and financial accounts, and so forth. So that's going to be very important that we're working on that. And then you're going to move on with maintaining and improving your Treasury operations. Do we have control of those bank accounts and cash? Do we have that visibility? How are we going to be doing our positioning? How are we going to do forecasting? We need to be able to ensure that we've determined our day one operating environment, our cash position, ensuring our legacy accounts have been transitioned, looking at our existing accounts have adequate cash available. How are we going to meet those requirements daily? And do we have to provide cash? Do we have enough withdrawals? Do we have enough funding, and so forth? And then as we're moving into the integration management pieces of it, we're going to be looking at making sure that we are meeting those end state integration goals, that we have a clear, actionable planning blueprint that's focused on that combined company. Our operation or model is prepared to support that, and we have the proper governance around the Treasury integration and oversight that's totally, fully defined with all those roles and responsibilities straight through. And then once we get our post-day one optimization, you're going to go back and look at those KPIs. Do we have that free cash flow? What our debt maturity schedule looking like? What's our debt to capital ratio? Do we have the organizational integration? Is it working properly as we expected? Do we have the proper governance still? Did we go through our bank account rationalization? Are we optimized with our AP and AR? Where are we? Is everything working as we expected? So once we've actually looked through and we've actually have very critical on making sure that we've actually looked at all those different keys to success and we're ready to develop that case, we're going to be really focusing on streamlining those processes. I wanted to bring this slide up because it points to some very important items on here that I think are very important to keep your eye on as you're going through those mergers and acquisitions, or even in the divestitures as well. You need to make sure that you're looking at centralization, looking that you're leveraging that technology, and looking at what's going on with your legacy systems, and that you're looking at what your current to-be systems are going to be, and that you're looking at making sure you're seeing that full picture of that single version of the truth. Looking at optimization, making sure those integrated processes are automated. Reducing any kind of dependence on any kind of manual activities. You want to make sure that you have full automation and everything is running as you would expect it. And then you have that ability to make any kind of changes, the agility, that you can quickly react to whatever's going on in that marketplace at any one time. If you're going to have another virus situation, you're going to have dropping in your interest rates, increased volatility in the marketplace, whatever it may be, that you need to be able to make those real-time actions very quickly to optimize all of your cash. Have to have visibility.
Yeah, Kim, I love this slide. We've used it a couple of times before, and I think in this case it's really great. And maybe get some thoughts from Julio or Bob in a moment. But I think what's great about it is the whole purpose in many cases of mergers and acquisitions. And we know that there's two different things, right? There's a merger and an acquisition. They're a little different, but at the end of the day, the idea is that you're trying to improve the business by harmonizing those businesses, streamlining processes. Julio, maybe you can comment, and then Bob for a moment as well. Julio, from an accounting perspective, your thoughts, and then Bob, I know we're going to move into CFIN in a minute, but you can talk to it from a technology perspective. Julio?
Yeah, well, obviously, streamline the processes, as Kim mentioned, is really, really critical. As you see on the screen there, whether you're doing centralization, you're doing a decentralization, having that technology to really help you integrate processes. So let's just take one example for very simplistic example. If we think about the accounting close process, when you have a merger or acquisition, you have basically, you're trying to, especially a public company, right? So a public company, you merge on day one, but 90 days after, you have to file your first consolidated report. So how does a merger and acquisition impact your closing process? Well, it does 100%. So if you think about it, you have to now figure out a very quick way to start putting separate company systems which actually report the numbers into one consolidated format. And this is exactly what we always talk about when we talk about advisory services, John, is that these are the things that we see consulting companies, big four companies coming in to really help, because a lot of companies don't have the time to do this. So when you come in and you say, okay, what is my closing process going to look like post-acquisition? There's about 100 things on a checklist that you have to think about. And Kim mentioned a few of them on the Treasury space. But if you think about sales, if you think about marketing, if you think about manufacturing processes, you think about the back office in accounts receivable, accounts payable, it's so much to think about where you say, okay, how am I going to close my books to make sure that when I release my reports to the public, I have the right numbers there and they're accurate. There's a lot of work in this space, John.
Yep, absolutely. Bob?
Incredible. And if you don't have that checklist, like Julio said, and go down that checklist and make sure you're ready to, to stand up those two companies together and merge that for your day one activities, and then of course your post merger for all the reporting that's going to come out after that, you're going to be in trouble. It's a lot of work to get this all in order before you start actually enacting upon the new organization.
So John, and thanks Julio and Kim. So I like this slide too as well, but the client I work with, which was a Fortune 100 going through a merger, and in general, it's the centralization optimization, but the word I think of is synergy, right? It's the synergy between the two organizations, and what we're seeing on the screen is the output of that synergy. So, when they're going through the merger, it's the centralization, it's the optimization of the process, it's efficiencies, and it's the business case to have done that merger to begin with. And my experience has been the synergy of the two organizations now combined as one strong organization for a host of these different reasons. And I know we're a little close on time, so I did want to go to central finance. Kim and Julio, if you were done with these sections, I think that's what's coming up next, John.
I think we actually have one more.
Okay.
Almost fine.
And I'm gonna be real brief on this. I just want to put this in there so you can this actually goes in concert with once you've actually streamlined your processes. For example, in my space of treasury and cash management. So, I don't look at the treasury TRM piece of it. It's actually looking at all of your payments, your bank communications, your working capital management and your cash and on all your investment activities and so forth. But if you look at it within SAP, our digital core is in one place, and we actually are fully integrated with our governance of risk compliance, and we have full integration with all of it's important to have that straight through processing from your trading platforms, with your banks using multi-bank connectivity, or you could use SWIFT, as looking at any kind of market data that we may have as far as interest rates, foreign exchange rates and so forth. And of course, as we were talking with Julio, all of our regulatory reporting as well, by having that hub of everything in one place so you can be very nimble and have all that information at your fingertips.
Yeah, and Kim, from my perspective, and we'll move to CFIN because it's a perfect segue. The beauty of a solution like this with SAP is that it sits in this core, but it sits in what we've discussed, which is an ecosystem.
Mm-hmm. And
because SAP recognizes that treasury finance is an ecosystem, it's not simply what I do in SAP or what I do in SAP treasury management, but it links to things like your trading platforms, your regulatory reporting, your tax. In Europe, you have SAFT, or you have different payment schemas, you have a lot of different aspects to that. But SAP has set it up in a great way to take advantage of that because of the open APIs, because of the communications setup. So, absolutely. Bob, we talk a lot about, how do you make mergers and acquisitions work for you? What's the technology solution? I think central finance, and I know you and I have talked about this, central finance is really a fantastic mechanism. Why don't you talk about that?
Sure, sure. And just for everybody who's joining this audience, I know we've done previous webinars on central finance, but let's level set briefly, and then
Sure.
I'll specifically talk about why it's such a strong platform for mergers and acquisitions. So central finance is a deployment strategy that uses S/4HANA, where you essentially replicate postings, financial postings from SAP and non-SAP. So that in itself is what central finance is. You harmonize and you post here, and it's on an S/4HANA platform, which then allows you to run all sorts of financial activities and processes by bringing in SAP and non-SAP data. And John, if we can go to the next slide. So real briefly here, this is, as I described, you're bringing in SAP and non-SAP. And the key to this during an M&A is the fact that you can allow your M&A to occur without having pressure. You're taking out the complexity out of your M&A, and you're not disrupting that process. And you're going to a common platform, which now will allow you to analyze your business, your new business, because you're replicating both SAP and non-SAP. And in the specific case that I work with, it was a large client buying another large company, and the company that they were acquiring had 14 general ledgers, John. So how do I go to a common reporting template? How do I do consolidations, these basic activities? How do I have a common reporting view? How do I do my month-end close when I've got 14 different general ledgers I have to deal with? And if I was to bring them in all one at a time to whatever my system was, whether it's SAP or S/4HANA, it would take forever. So the decision was, we'll use central finance as the platform, as the common denominator, so to speak. So if we can go to the next slide. And so these were the classic central finance use cases, okay? And the one highlighted is mergers and acquisitions and process centralization. So by using central finance as the platform related to mergers and acquisitions, it allows me certain advantages. As I mentioned, taking the complexity out of the M&A. I've got a repeatable playbook, which I'm going to touch on in a second, which I can plug and play, right? I don't have that urgency to bring everything into one single instance or system, because guess what? I'm bringing it all into central finance, and I'm harmonizing it there, and I've got a common data model, and I can mix and change these dimensions in this common data model. And that's why it's such a perfect fit for mergers and acquisitions, John.
Yeah, and I don't know if you're going to talk about it, Bob. I think you are, but the tool that's provided by Magnitude that helps you with all of that data harmonization is fantastic. And we're going to be doing a webinar with them towards the latter part of May. But the fact that they have over 20 some odd different ERPs already established with already established connections into central finance makes that even more powerful, right?
So that's an important point, John. And by the way, my client was also using Magnitude's tool. Is we focused on process, but just as important as process is the data, right? Because I could have an apple in one place and an orange in another, and how do I harmonize this data, underlying data? And that's where Magnitude's tool comes in so well. So I know we're pressed a little bit at time here, John, but I want to talk about here are some of the the value pillars that you would use, right? That would allow me. I can do advanced and timely reporting. I can have a shared services model. So as I'm bringing in these ledgers, so my client decided they grouped the ledgers together. So I can bring them in geographically, or I can bring them by different systems. Let's say if it was Oracle ledgers or PeopleSoft or even SAP ones. But it allows me to have this type of build. So let's go to the benefits, John. So here are the top benefits of central finance in general. And I know we've touched this upon these in other webinars, but it's the transparency, it's the flexibility, efficiency. Kim talked about the working capital improvements, but really, I think it's the business continuity that applies to M&A situations. And the next slide I have, if you would go to the next slide. Okay, so this is kind of, the key is, and I've touched on some of these, is I've got, now I don't have to rush to bad decisions. I can take my time going through my merger, and there's always a lot of pressure during these activities. But by having central finance as a common platform, I'm not disrupting everything else. I'm not disrupting my business. I'm not disrupting the merger process. So I do have that common platform. The reproducible playbook, as I mentioned, allows me to have a common model and a common playbook that, as I, a lot of times companies, as we sometimes joked about, John, we talk about serial acquirers, right? So by building the central finance as a platform, I can, buy additional companies. I can sell additional companies without being chained really to the systems themselves. The reporting framework, now I've got a common reporting template. My client, they had series of meetings with all the divisional controllers to come up with one common reporting framework, because how, it's likely the company you're acquiring was measuring their business and had different structures and how they viewed it. So what central finance allows it is to have an agile consolidated reporting framework by, during, and being able to add different dimensions, being able to slice and dice. And then the one point I wanted to also add with John too, is consolidation and planning, right? So now I've common platform where I can use SAP's newer functionality, group reporting, to do consolidation and to do common set of planning. So that was the other benefit. So let's talk about tech.
Yeah, and I know a lot of companies.
Sorry.
Yeah, a large number of companies, whether it's companies like Google, Apple, many others could use, as they do their mergers and acquisitions. Google in particular is a great example. Koch Industries might be an interesting example, or others. As we begin to see consolidations, let's say in the oil industry, some of these larger companies could take advantage of this for sure. Right?
Yep, and it's funny you mentioned Coke. I know Coca-Cola did do a central finance project a couple of years ago as well. So yeah, it just sets that platform. And one of the thoughts around that too is, if I'm buying and selling, I don't need to integrate them into those my key companies that may have been in my common platform. This way, I can keep them on their own instance, but I still have the financial visibility. And as you know, SAP's always rolling out new functionality, so I can go to a shared services model and do treasury and receivables and payables on the common platform without disrupting the business.
Yep, absolutely.
Okay, and then next slide. Some of the things to think about are related to the technology, but one of the things I would also say that came across for our client that's not necessarily central finance, but something to think about in M&A is just the sheer volume, right? So maybe your systems have limitations on the amount of payables you can run in your payable processing, your payroll, things like that to think about are kind of day-to-day things you wouldn't think about, but just the volume. So one of the things to think about is just the whole testing and the stress testing as you're going through an M&A process. And those are some of the technology things to think about. And some of these are come up with a common governance structure, common security, privacy. As Julio mentioned, different cultures, different policies. So these things have to be worked out as part of the whole M&A process as well. Okay. Kim and Julio, I'm going to turn this over to you here at Kim. To you, Kim.
Yeah,
is there anything else you wanted to add?
Yeah, I just wanted to add one small thing. I put the slide in here, and just for one point, I was actually on the acquiring company side for the acquisition, and And one of the things that I've seen done, which it makes it much more difficult, is when you try to take all of your systems and try to integrate them from various, let's say you have a JD Edwards, you have an S4, you have, various flavors of your ECC and so forth, and you try to pull those together and set a treasury system on top of it, it doesn't work that well. So with central finance, which is what I like about this, that instead of trying to putting your treasury and risk management on top of several source systems that may have, different conflicting master data, as you can imagine, because everybody's going to do it a little bit differently. It helps to put into a central finance on top of a central finance, so you can bring all that required master data and transactional data together and harmonize that information, and it makes it much more easy for you to be able to run your SAP treasury and risk management processes.
Yeah, you mentioned one of those other things, John. I used the word synergy previously, but it also central finance with mergers and acquisitions also allows for cost synergies, right? So that's the other factor.
Exactly.
So be another key element of it. You can tell I'm a big fan of central finance, especially. So I'm going to transition it back to you, John and Kim. And as I mentioned, we've had webinars previously on central finance, and if anybody has even general central finance questions, please either reach out to myself or John.
Yep, that's all that I had to add here.
All right, well, thank you, everybody. Let's take a moment to wrap up. As always, terrific content. I hope everybody got a lot out of it. As Julio said, we think of these times as challenging and what's going on in the M&A world. And really, I think it's positioning yourselves for the future of M&A. They are going to happen despite what some of our senators and representatives might wish. M&A is here. M&A has been here for thousands of years and will always be here. And so, how do you identify, assess, and mitigate operational organizational risk? One of the core essences that we bring to the table is about Treasury. You want to bring Treasury to the table early, have that early discussions around things. We did a recent project for a large technology company in which they harmonized bank accounts, and they got tremendous synergies out of harmonizing those bank accounts. That's also an opportunity. S/4HANA Central Finance delivers harmonized information. I am a huge fan, like Bob, of Central Finance for lots of different reasons. I think it is a great way to jumpstart your journey into S/4HANA. I think it's a great way for companies to really learn and get adjusted to while gathering all the finance together and managing supply chain. So again, the way to start, the way to get things done is start now. Reach out to Bramasol. We have accounting advisory, treasury expertise, IT expertise. We're here to help you. As the leaders in finance and finance transformation, we start with a base, a foundation of SAP S/4HANA. On top of that, we build our deep analytics. So we build dashboards, disclosure tools with capabilities that allow drill down, drill back, and drill through. We do that and are experts in the procure to pay process, everything from the minute you decide to acquire an asset to when you offboard that asset, and look for some more of our webinars about that. We have deep expertise in the order to cash, record to report space around revenue recognition in particular. And our deep experts, Kim and her team, many of them bring well over 25 years of experience combined. I think you guys have a couple of centuries worth of experience in SAP and are running some really great projects. So please, hopefully you'll share this webinar with your colleagues. Please feel free to download it. And remember that Bramasol is the leaders in business transformation, finance compliance, and we look forward to seeing you on further webinars. Thank you, everybody. Stay safe and make it a great day.